We have to kick it off with this historic move from the BOJ, hiking rates for the first time since 2007 and scrapping YCC. Your reaction?
I think there's not much. I mean, I've just read the statement like you, and I listened to the excellent report that you just had from your correspondent there in Tokyo. I think that really summarized it. But what I think is important for viewers to also note is that they are still engaged in bond buying. They're still engaged in balance sheet expansion. They got rid of ETFs. They got rid of the J-REITs. They got rid of risk assets. They're not targeting a specific yield. So the QQE and the YCC are gone. But the QE is still there. And that's QE that's up to them. They can define how much and when they want to do it. And as you said in your earlier discussion, they can come in at any time if they see an unwieldy period in yields in the back end of the JGB market. They have every tool in the book to respond to that. So I think that's an important part of the stimulus that's still here, even with rates obviously at 0 to 10 basis points being stimulative relative to the rest of the world. This isn't some sort of move toward a very hawkish stance. It's still a quite easy BOJ.
You know, I think you make a really great point, but at the same time here, we're looking at the yen sliding because the BOJ has not really provided any guidance on what's going to happen next. So what does the path of future rate hikes look like? And is that even something that the BOJ is considering right now?
Well, remember, most of the sort of intelligentsia in the macro community over the last year or two have been talking about a BOJ rate hike and the end of YCC as a reason why dollar yen would collapse and why JGB yields would hit, head north and go into the stratosphere. Neither of which has happened. We're still sitting around 75 basis points in JGB yields, 10-year, and we're at dollar yen 150. I think Ueda's actually executed an unbelievably successful policy in that he's managed to get done with the extremities of monetary policy, the very extreme moves into QQE, YCC, buying of ETFs and J-REITs. Now he's just in a very standard QE, and he's in positive rates, and he hasn't actually sent the yen soaring, and which I think is great news for Japan. The number one reason why we're here in the Nikkei and why we've taken out those all-time highs is because we've managed to keep the weaker yen in place, which is ultimately what Japan has needed for the last 30 years in the wake of the debt and deflation mix that hit this economy post the bubble popping in the late 80s. So I'm excited about Japan. I've been excited about Japan. I think Ueda's tactically done a great job of somewhat normalizing. You can't really call it normal policy in Japan, but somewhat normalizing policy and not seeing those negative reverberations. I think it would be much worse for the market and global markets if the yen was strengthening a lot here or if JGB yields were rising a lot in an uncontrolled way. Both would be very detrimental to global financial markets.
Right, and part of the reason we see weakness in the yen is because the Fed has been moving towards this higher rate regime stateside. And I want your take on that as well, David, because in the US, we now see traders setting up for what may be fewer cuts given this strong run of economic data. What is the Fed going to signal, and could we perhaps see a shallower cut cycle than previously expected?
Well, remember, the Fed has been pretty consistent with what it's been saying. The market is the one that's kind of gotten itself all excited about March rate hikes and 6 hikes, I think, were priced in at our 6 March rate cuts and 6 cuts priced in for 2024. Much like 2023, where we had 2 rate cuts priced in at the beginning of the year, and we ended up getting 4 rate hikes. So we had 100 basis points of hikes when the market was forecasting 50 basis points of cuts. Now, importantly, in 2023, even though the market got it completely wrong and the Fed kept telling them they're not interested in cutting, the equity markets and the risky parts of the credit markets all did great last year. We had a 24% rise in the S&P and a 14% return in high-yield bonds. So the market doesn't need cuts. The market doesn't need to have the Fed baby it. What the market is keying off of, and why I think stocks have had a great start to the year, is just the ability that the Fed can cut. Meaning, if something goes wrong, if it's needed, they're not fighting the same inflation battles they were before. Inflation's back down into the low 3s from over 9% a year and a half ago or so, a little more than a year and a half ago, were the peaks, summer of 2022. That is a great cushion. The Fed put structure, for lack of a better word, is back, and that's been our theme at Jefferies. That's what we've been pushing since the beginning of this year, and really this idea that you can see significant rate cuts if needed, not necessarily that you're going to. We might not need them. And what we found out so far this year is we really don't need them. The economy is doing quite well. The inflation's a little bit stickier. The Fed can hang back and probably steer clear of some of the political landmines that might come with larger rate moves in an election year. And I think that the important point for everybody to understand is the ability to conduct large-scale monetary easings if they were needed is back. And that's a cushion to the markets.